Hey everyone, welcome back to Yuri's Box. In this video I'll be looking at the data released today, Thursday 1st of May, as well as the report by Apollo headed by Torsten Slok. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So the morning started with the Challenger job cuts. We got 105k, Trading Economics had a forecast of about 290k. Most of them seem to come from the private sector. So we had 2,700 job cuts announced by basically Doge actions in the month of April, which again leaves us with about 103k, 102k in the private sector. So that is noteworthy. However, job cuts usually are a lagging indicator, meaning by the time job cuts and layoffs and all that bad stuff peaks out, that usually marks the end of a recession, not the beginning. And on the same note, we had a spike in initial jobless claims really across the board, both with initial jobless claims and continuing claims. We had here we are, 241 against a consensus of 223,000. Of course, this marks a big jump. The last time we saw this kind of jump was in February, and actually it then retraced back down. Regardless of where the next numbers are, will come out. If you've been following my previous videos, I've pointed this out many times. We saw the same thing happen last year, where you had a bottom in January and the direction of travel for initial jobless claim was up. It wasn't, straightforward, but you can definitely see the trend here. The same thing I've been arguing for again this year, a bottom in January, and basically, direction of travel for jobless claims is up. I'm not too obsessed by the initial jobless claims number because of what I just finished saying before, meaning by the time initial jobless claims, spike, it's already too late. The analogy I like to use is that, imagine you saying, I'm not going to shower until I smell like rotten eggs. Yeah, by the time, you smell like rotten eggs, it's too late. You really should have showered. So again, if you're arguing for the Fed not to cut because initial jobless claims are low, you're bound to be late. That's the moral of the story. And again, initial jobless claims in the 2008 cycle, they peaked out in March of 2008, which was practically the end of the recession. All right. So if you're waiting for initial jobless claims to have an explosive move, you're waiting for bad stuff to happen. All right. As far as the continuing claims are concerned, we actually saw a new cycle high for this cycle. Again, we're at, this seems more dramatic than it actually is on a historical basis, right? We are way below trend, really, and well below historical lows. But in any case, we do have a new high for this cycle. And I think that this is consistent with everything that, we've been pointing out on the channel, that we are currently in an environment where, yes, layoffs are still low, but hiring rate is relatively subdued. Let's bring that up for a second here. All right. It's definitely not at COVID lows, but that wouldn't be anything you'd like to see anyway. But regardless, hires are back at effectively 2015 levels. All right. We are well off the highs that we saw in 2022. Potentially building on the idea that if you have a job, good, but if you lose it, it gets harder and harder to find a job. Again, continuing to build on that low hire, low fire environment. And that is actually what opens up really the window of opportunity for any kind of shock to come in and do all sorts of nasty stuff in the economy. And it's in this kind of environment where you'd like to see a more supportive policy to the economy, because it's really what the economy is really asking you for. But again, this is speculation for another day and another video. We also got the final read on the S&P PMI manufacturing report. Overall, it was nothing much of a report. In fact, it is only a page long, really. And it's really nothing new. Nothing that we haven't really covered on the channel. Manufacturing sector expanded only marginally in April, subdued growth. Confidence in the outlook fell to its lowest since June. Tariffs causing increases in prices. Manufacturing continued to flatline in April amid worrying downside risks to the outlook. Many firms expect to see growth in production, basically due to the fact that tariffs will likely boost domestic manufacturing. That didn't help with sentiment. And again, present price trends show input prices rising at a fractionally slower pace than in March. Good, but again, it's nothing too dissimilar from what the previous PMI reports have been pointing out, meaning outlooks in the dumpster. Present conditions are meh, okay, at best. And you have inflationary pressures due to the tariffs, right? And everybody trying to front run the tariffs and are just trying to scramble around and trying to, get your hands on as much as you can before the tariffs kick in. Then we had PMI report. And again, this is another case of the number is better than consensus. So hooray, everything's looking better than it is. But then you open the report. I mean, there isn't anything necessarily optimistic. Again, new orders and backlogs contracting. And again, this is probably one of the most important things to look at in these reports, because again, what drives employment? Well, if you know that new orders are coming in, if you know that what the future holds is more demand, well, then you're going to need more workers. But if you know that the future holds less demand, well, what are you going to do? Increase your workforce? Your workforce? I don't think so. All right. But again, this is what the PMI had to say, the ISM survey had to say: new orders and backlogs contracting, production and employment contracting, price increasing, and exports contracting. Manufacturing sector contracted in April for the second time in a row. If we go lower here, what respondents are saying, tariffs are impacting operations. Tariff climate and business climate is apprehensive. All inbound shipments from China are on hold. Tariff whiplash is causing us major issues with customers. Again, it's nothing really new, compared to previous reports. And if you actually go down here to, single sections right here, you would have saw some reprieve in the month of April. You saw a 2-point bounce compared to March. However, production went basically down the toilet, down 4 points, down to 44. Employment saw a gradual increase. And again, backlog of orders down, new export orders down. So overall, I mean, it isn't anything necessarily new. I mean, we started off in February where that kind of smashed the illusion that of really the economy, of what we thought the economy was, and in September through January. And we've been painting a picture that is more consistent with last summer. So again, reiterating the fact that tariffs are more likely to be seen as the straw that broke the camel's back. All right, we had already underlying issues that were bugging the economy well before tariffs. Although tariffs are definitely, putting a weighted vest on the economy. That's for sure. So again, ISM, beat on the headline number, but as far as the report is concerned, you're not really getting any indication that we're anywhere any different, really, compared to, well, what we've been seeing ever since February again. So that's for the ISM report. And again, what has been the response here? So overall stocks are still higher. All right, we're up by 1.2%. And again, I'm not surprised by this. Overall, I was open to the idea, and I still am open to the idea of a revisit to the 57 to 5800 level on the S&P 500. Again, similar to how I was open to the idea that we might go back to 5900 back in the end of March. We just stopped shy of that at 50. What was that? 5800 more or less. Again, a lot of where we go from here will depend on tomorrow. Same goes for things like TLT. Yields are up by about 4 or 6 basis points depending on the maturity. 10 is up by 4. 30s are up. Well, let's round it up to 6. And again, if you get good news, and again, this reiterates also the fact that we are in a bad news is bad news environment, and a good news is good news environment. Meaning, if you're going to get indication that the economy isn't as bad as we're hinting at, well, you'd expect things to follow the standard manual book, really. If it's good news, bonds will sell off and stocks will go up. If it's bad news, bonds will go up and stocks will go down. All right. The dollar is back over 100. Now, again, I made a video earlier this morning talking about the potential of a possible news failure and actually seeing dollar strength at the end of this week. You can't really argue for news failure necessarily today, because then, yeah, we did have higher jobless claims and continuing claims, but the initial reaction was, we didn't have a terrible reaction to it. What is definitely helping push the dollar higher is that ISM report. Again, the headline number beat, so that's kind of fueling, the idea that the economy is better than we thought, right? So what you'd expect, higher bond yields, and a higher dollar. The idea really is postponed till tomorrow, really, I guess. We'll see how the non-farm payroll report come out. I wouldn't be surprised, again, if we actually get a possible news failure on the dollar, meaning we continue to see dollar strength even if the non-farm payroll report comes in weak. Does it have to happen? No, it's just, my bit of dubious speculation. Tomorrow we also have the unemployment rate, and I just wanted to point something out. Currently, the labor force participation rate sits at 62.5, and it's kind of flatlined right here. If you go back to the 06-08 cycle, which is something that we've done extensively, the labor force participation rate held at more or less the same level up until September of 08. And then it actually just took a tumble. I could see some kind of a repetition again, where we just flatline around 62.6, 62.7, around this area right here. And then if we get that kind of, landing, whatever kind it is, then we go back lower potentially. That's just something to keep in mind. Given the fact that, as far as tomorrow's number is concerned, I still maintain my outlook. Again, non-farm payroll, 75K, unemployment rates, 4.2, barring any move on the labor force participation rate, which again, if we do get something like 62.6, I guess you could see 4.3 perhaps. But again, my base case is 4.2. Given also the fact that, going back just a minute to initial jobless claims, excuse me, my line of the sand, you'll know this, anything below 215 is an indication that you'll probably see unemployment rate go down. Anything above 220, you'll see the unemployment rate go up. We did get 240K today, but I got reminded about this today. I kind of forgot about this in my previous videos, that again, the survey week is actually 9 through 16, the 16th of the month. So this either way couldn't move the unemployment rate. Regardless, the numbers that we got were really 224, 216, 223. So again, we're just bobbing around that, break-even rate as far as, my 2 cents are concerned. So just looking at the initial jobless claims, that doesn't really corroborate paint the picture that we'll see a rising unemployment rate. I would think that if we do get a rising unemployment rate, that would come with labor force participation rate shenanigans, as I've said before. But again, we'll see how things move tomorrow. And that leaves us finally with the Torsten Slok Apollo report. Just for some context, Torsten Slok was kind of bullish on the economy up until a little while ago. I remember seeing him on Bloomberg Surveillance quite a bit. He was also arguing not too long ago that there might be actually rate hikes. I mean, maybe not rate hikes, but the spectrum of rate hikes, was out there. All right, given the fact that he saw strength in the economy and that, again, the rate cuts that we saw from September till December weren't really warranted. So that's really where he was just a little while ago. After Liberation Day, he really just kind of took on a more bearish tone. And in fact, his base case, if you listen to him, is now that we are going to have a recession in 2025. We'll see how the report, basically what the report says. Again, anecdotes from the past week. Southwest Airlines, I don't care if you call it a recession or not. In this industry, that's a recession. So the airlines are kind of, and again, if you've picked up any talk about the earnings that we've seen from Delta, United, Southwest especially, it really isn't, rainbows and sunshine at all. Chipotle had similar things to say. Saving money because of concerns around the economy was the overwhelming reason consumers were reducing the frequency of restaurant visits. PepsiCo, relative to where we were 3 months ago, excuse me, we probably aren't feeling as good as about the consumer now. And I think that this continues to contributes to paint the picture that this idea that companies are going to have just a swell time passing on their costs onto the consumer, and it's just going to be as easy as apple pie. Maybe not. All right, maybe not, given where the consumer is. And we've talked about this many times. If you look at something like, for example, the quits rate, and again, what the quits rate is, and again, we did have a tick up, but we're still at cycle lows. Is again that what consumers are telling you is that basically they don't see the strength in the economy. They don't see an economy that would allow them to switch jobs and use the ability to switch jobs as a way to increase their wages, which will likely lead to wages being sluggish, which will keep consumption kind of sluggish. And any inflationary bout any inflationary bout will more likely just hurt consumption even more. And again, the analogy that, you can kind of use it with Southwest Airlines. I saw George Gammon actually use this in his video earlier today, is that basically, again, even the car analogy that I used, it's mostly the same thing. If you're spending more money on the same amount of things and you don't actually have a way of increasing your wage, the end result is that you're going to spend less, you're going to have less money to spend on everything else. So let's say that you have $10,000 a month, just something ridiculous, $10,000 a month to spend. You use $5,000 to spend it on what you need, and you have another $5,000 left to spend it on South Airlines tickets, all right, on travel. If all of a sudden you're spending, if again you have no way of increasing your revenue, so your wage, you're stuck at 10K, and what you spend on what you need goes up from say 5,000 to 7,500, all of a sudden you're left with 2,500 to spend on Southwest airline tickets. All right, so you're spending more money on what you need on the same amount of goods, really. And what you're left with is less to spend on, your favorite airline, your favorite fast food, and your favorite, soft drink. So that is where that's the camp I've been in. And, the more you read these kind of anecdotes, I mean, they continue to push us in that direction. And this is kind of the timeline that Torsten Sloks and his team points to. You have April 2nd with Liberation Day, and about 20 to 40 days, transit time. You might start to see imports of container ships to the US in early May to mid-May. Trucking demand after that gets a hit because, of course, if you don't have anything coming in, you have nothing to transport. So, trucking gets the stick after that. And as of late May, early June, the layoffs start kicking in trucking and retail industry because, again, lower sales. So that's kind of the timeline. How are firms responding to tariffs? Rapid down reversion to earnings, new orders falling, CapEx plans falling. And again, CapEx, what is CapEx? Think about it. A company spending money to increase operations, let's say you buy a new warehouse because you buy a new plot of land because you want to build a new warehouse, you want to buy new machinery because you want to increase production, that kind of stuff right there. Inventory is rising before tariffs, again, front running of tariffs. And again, here you get a few slides pointing to, the earnings outlook actually getting massively downgraded. And the only time we really saw something like this occur came in really the lead up to, the COVID recession. Overall, this also kind of also paints the picture of why potentially you could see, just for the time being, more follow through on the S&P 500, for example. Because again, these earnings aren't for the current quarter, all right? You might still get okay earnings for Q2, for example, because again, that's just baked in the cake, all right? But, meaning for Q1, excuse me. But after that's when the problems arise. So again, you might just get good numbers for the time being, but simply because they're already baked in the cake. So that could also spur further follow through. And we could actually get above, possibly this local high right here. Who knows? That could also, fuel the current rally. And new orders collapsing. Again, this is something that you've heard me talk about ad nauseum. In all the PMIs, the ISM, yada yada yada. If new orders are collapsing, what are you going to do with your workforce, right? At the very least, you're not going to expand it, right? You're not going to hire new people because you don't have any new orders coming in. So, and usually another good way of gauging that is also the average weekly. I always forget about it. I'm always, going to panic that I'll get the wrong, here we are, get the wrong chart. Regardless, again, we currently are back at effectively COVID lows. All right. We also could see, I think ADP hinted at this yesterday that, potentially the work week might go up a bit. But that doesn't change the fact that we are still at cycle lows. And again, from here on out, if you have already, an okay workforce, all right, you have what you need, and you've already cut their hours. If the economy, let's say, were to, everything clears up, you could see potentially that instead of hiring more people, you just increase the work week, right? So that is also something to consider in the case, everything clears up and, it's clear skies ahead. And again, before you go to layoffs, even in the face of collapsing new orders, what do? You just cut back on the work week, all right? Regardless, new orders are down. That hasn't historically a great leading indicator. I mean, the fact that it's down isn't an indication of great news ahead. That's what I mean to say. Again, sharp reversal in corporate capital expenditure plans. And if you know that that the outlook for the future isn't that great, or at the very least, if you know that the water is kind of murky at this point, you're more likely to stay put. Say, you know what? I'll stay put. Let's wait until everything clears up, and then I'll make my decision on making huge investments. You're putting millions on the line at a time where everything isn't clear. You don't know what the path forward is. Why put that money on the line? Just wait, sit tight, and wait for clear skies ahead. But again, if enough people do it, it's enough to further slow the growth of the US economy. And again, prices paid rising. This is hardly new news, if you will. The tariff front running has certainly contributed to this. You have just a scramble for goods leading up to tariffs. And again, this isn't me not really putting too much emphasis on inflation. Doesn't mean that necessarily won't see inflation go up. All right, we might see inflation tick up, maybe even as up as 4%. Who knows? But remember what happened in say like 2008. We had a slowing economy. All right, and if you don't believe me, just look at, for example, non-farm payrolls. Just look at August of 2007 till really the peak, July of 2008. So August of 2007, right here, we were at negative 25K. And in July, right here, we were negative 200K at a time where inflation was going up. And we went up to 5.6. And actually, a lot of that, we went over this many times. Oil was a big contributor of that. It actually peaked. I looked at the chart after that, and I thought it was 120. Actually peaked at $150, $160. All right. Regardless, we had growth slowing, and yes, inflation was at 5.6, but then it just fell like a rock. All right. Eventually, growth is what is in the driver's seat. If you don't have an economy, you don't have inflation. So that is kind of where I am. All right. And again, new contraction territory in March for the decline in April. If I'm not mistaken, we actually saw that in the ISM report. New export orders, 43 new orders. Right here, it did have a slight uptick, but nothing too dramatic. All right, it's still contracting. All right, so fair game to Apollo. And inventory is rising rapidly. We all know this before tariffs take effect. Again, this is all of the regional surveys. We've gone over this many times. And again, truck sales down in March. Again, what is this an indication of? The fact that the future holds less demand. Simple as that. If you go back to the timeline right here, if you have nothing to transport, what do you need a truck for? I mean, so it's as simple as that, really. And again, CEO confidence is declining. And really, up here, we were kind of pricing in all of the good stuff and none of the bad stuff. We were really ignoring all of the, warning signs that we had, even during September till January, when we had that, what I quote unquote artificial high in the economy. We still had the same things that were lingering in the space from the summer. But again, we had a lot of transitory events, again, using the T word, that probably contributed to making the economy look better than it was and inflation look worse than it was. And on top of that, we had an election, which made probably everyone a little bit too enthusiastic about the fact that we would get the goodies first, so all the candy, meaning tax cuts, and the tariffs later. Well, we got the timing wrong. We got tariffs first, and now even the tax cuts that we're talking about, I mean, we're not talking really about, as far as I can see for the moment, any further new tax cuts. We're just talking about renewing the tax cuts. So anybody really drawing a comparison to 2018, it's really a worse version of 2018, if you will, because we have a tariff drama that is way worse than it was in 2018. And in 2018, we had tax cuts which were brand new. All right? New tax cuts will have an effect on the economy. Renewing the current ones is just avoiding a negative effect on the economy, because, again, not renewing them will just be a tax hike at that point, okay? So, again, it was just too much enthusiasm right here, potentially. Again, that doesn't necessarily mean that we're definitively heading to the dark ages, but again, as I said in my initial videos when I first started making videos on the channel, consensus at the beginning of the year was growth optimism, pessimism on inflation. Again, I continue to reiterate, it's probably the other way around. A bit more pessimism on growth is probably more warranted. A little bit more optimism on inflation is probably more warranted for, more data here. Trade between China and the US is coming to a stop. And again, I wanted to just stop on this topic for a moment, because I continue to see, and again, I don't really make it any secret. I'm, again, bullish. I never made it a secret, actually. I'm bullish on bonds, and I'm still somewhat constructive on the dollar. I continue to see, we've seen, ever since the beginning of the year, just sell US stocks, go to Europe, because that's where you want to be. And again, I'll push that against that once again. I made a video on that about a month ago, that, it's time to sell the S&P and go to the DAX, for example. And I'll reiterate what I said back then. Do you really want to be in German stocks or European stocks? I mean, productivity-wise, the only place you want to be in the world for the long term is the US. All right, that's the moral of the story. As far as bonds are concerned, do you want to just sell US bonds and go for German bonds? Because again, now Germany is spending, and you're going to have a huge defense package, coming into force in the future, and so that'll propel new growth in Germany. But let's not forget something that I've brought up many, many times, even in relation with the DAX. Germany had its entire economic model put upside down, all right? And really, we're talking about mainly Europe here. Because, I mean, the growth model, what was it? You get cheap imports from Russia, cheap energy imports from Russia. You use that cheap energy, that cheap import to make goods, which then you export to China. Well, now everything's kind of upside down at this point. So you have a country and really a continent that has really just had its entire economic model just upended. Is that an environment where you'd feel comfortable being for the long term? Just because you have a huge spending package doesn't necessarily mean that, you're going to become, the land of Oz again. Things are more complicated than that. So again, I continue to see this pessimism on the US, optimism on Europe, optimism on China. But again, going back to the chart here, it's not like this isn't causing pain on the China side. All right. Chinese companies will have a hit because of this, because, again, all exports are stopping. And let's not forget, one of the problems that, the US is probably trying to address here is the fact that, China doesn't have any internal demand. It basically exports everything it produces. So again, if all of a sudden your exports take a hit, you don't even have internal demand to fall on. So again, I continue to see this huge bearishness on the dollar. And again, that doesn't mean that this is the bottom necessarily. Absolutely not. Doesn't mean you should go leverage 100x, not just buy, a lot of Benjamins and, just go with it. No. But what I continue to see is this huge bearishness on the dollar, and go long euro, go long China. Not so fast is what I say. I mean, I do believe that a lot of the pessimism. I mean, some of the pessimism is warranted. All right, we've seen certain things that aren't constructive, mainly the Trump-Powell drama. We've seen really the U.S. become a source of volatility with, Liberation Day. That certainly didn't help. But as far as the rest of the world is concerned, I don't really buy into, at least just yet, the idea that, the US is doomed and now we're going to have a renaissance, and in all of and the rest of in the rest of the world, really. So again, I just thought, it's good to make a point out of that. Again, China will feel pain because of it, all right? Europe will have to make decisions, all right? And, eventually, just to finish off on this point, I wouldn't be surprised again if in say 6 to 12 months we're not talking about tariffs anymore. If things actually get bad, and we get to a point where, because we have to spur growth, everybody just comes to the table, and so might be in a situation where the US is not in a great position, but Europe is in a worse position, and China in an even worse position. So everybody's kind of hurting. And because everybody's kind of hurting, everybody just wants to deal. All right. So perhaps, again, the EU gets more energy imports from the US, starting to decouple from Russia, more arms imports from the US. And perhaps, you get a huge deal with China around the possibility of rebalancing, as Besant has been talking about a lot. Again, pulling back on the exports, having more internal demand. Who knows what the future lies? But again, I wouldn't be surprised again if tariffs just completely fade in 6 to 12 months' time. But again, that's definitely way into the future. So again, China to US trade coming to a complete stop. Again, this will continue to hurt both sides. China as well. It's also good to remind yourself, China isn't, Goliath. All right, yeah, they have their strengths, but they also have their weaknesses. I think it's good to remind ourselves of that. And how consumers responding to tariffs? Consumers' confidence is at record lows. Front loading of purchases. Tourism slowing, in particular international. Again, here we have families with income greater or 100K, families with an income less than 100K. I think that, as far as, what is more significant, I would put more emphasis on the first category, meaning families with an income greater than 100K. Because, again, you've heard many, many times, the K-shaped economy, where you have, basically the bottom half hurting a lot. But because the top half is doing so great and so good, it's kind of kept everything chugging along. And yes, the bottom half is being hurting, and way more than the. And again, you can see it in the spread here, right here as well. The blue line is less than 100K, green is above 100K. And again, you continue to see the spread right here, and actually spread growing as time goes on. And again, I would just call into question again the S&P 500, which is relevant rather to this part of the report, because again, you also have to consider the wealth effect. All right, the fact that the more money you have, the more exposed you are to assets. All right. And the more exposed you are to assets, per se, let's say stocks, and stocks are going up, well, that's just going to add to your spending capability. And if all of a sudden you have that reversed, what's that going to do? Well, sentiment will likely tank. And again, I wouldn't be surprised if a lot of this is due, well, not a lot, a good part of this is possibly due to the fact that asset appreciation has gone the other way. All right. So again, continue to build on that. Consumers are very worried about losing their jobs. And again, this is kind of where it gets to, recessions becoming, you definitely have there is some truth to this. Again, that recessions are kind of a self-fulfilling prophecy, because again, think about it. If you think that everything's going to be all right, well, you're going to keep on spending, and so companies make money. Companies hire because they're making money. They keep on making more money, and it's just a self-fulfilling cycle at that point. If you think that a recession is coming, well, you're going to spend less. Then companies are going to make less money, and they're going to hire less, and it's just a negative feedback loop because of it. And it is also why, it is another reason why potentially the Fed is always usually late. Because if the Fed acknowledges weakness, it's just it's just ushering in people getting worried. And the fact that people get worried, then they spend less, and we get into that negative feedback loop. So it's in the vested interest of the Fed to say that everything's great until it isn't, and they have to do more than they otherwise would have. So keep that in mind as well. A record high share of consumers think business conditions are worsening. Again, no surprise there. This is still consistent with what we've been seeing in all the regional surveys, the Fed Beige Book, and all that good stuff. Inflation expectations have been on the rise. However, I've poked holes on that many times in my previous videos, where you have, again, a lot of the Democrats, for example, expecting Weimar Germany. Republicans are expecting, yes, we've seen them tick up just marginally. But, the problem with these consumer surveys is that a lot of it is usually politically motivated. Regardless of that, we also have 2008 here. All right, we had a similar situation occur. Again, we had inflation going up, but eventually the lack of demand rather, was just too big to ignore, and we had inflation just tank. We were in deflation territory, right? We were right here, well below. And again, inflation expectations were still relatively high up until this is for the next 12 months. Even in 2009, as the recession ended, and let me see if I still have it open, or I'll open it just now. As 2009 approached, we were still in deflation territory, right? So again, we went up, definitely, with the reflation coming back in, and growth kind of coming back in. But again, it really depends also on where you are in the cycle. But again, that is something that time will be the judge of. Consumer confidence in the next 6 months, business conditions, worsening. Again, building on the fact that, if you think things are going to get worse in the future, what are you going to do? You're going to spend less, especially, again, if you're worried about their job. If you're worried about your job and you see fewer jobs, what are you going to do? You're going to stay put, because you're not going to hunt for another job. And you're going to try to basically hold on to your job for as long as possible, because that if you don't find a job, if you lose a job, it's going to be harder and harder and harder to find a new job. This is something that potentially the continuing claims is hinting at. We have a fresh new cycle high at 1,092,900 at 9,200,000 rather on for today's initial jobless claims report. Fewer Europeans are traveling to US. Again, people have made a lot of speculation that this, again, everybody just chucking the US to the sidelines. I would think that this is more indicative of actual people, again, going back to what we saw right here, or even what I was talking about at the beginning of the video. Again, Southwest. If you see, and again, this is valid for international, not just US consumers. If you think that, or rather, if your wages are staying flat and prices are increasing, you don't have much left over to spend on, say, travel. So I wouldn't, be too doomsday about, the fact that we're seeing, fewer Europeans traveling to the US. Again, on the consumer side, share of credit card accounts making just minimum payments is going up. Delinquencies are on the rise. And just continuing to build on the idea that, especially the lower half of the consumer is hurting quite a bit. They also throw in Las Vegas. Las Vegas tourism is declining. This is just for the heck of it. And I think by the time they got at page 34, he said, "Why not throw in Vegas?" Same store, retail sales. Still kind of hanging in there, but well off the highs for the cycle. And we have hotel demand here, but again, I think the meat, the beef is in the in the previous slides. And again, this is also quite relevant as well. S&P revenue from China. This points to the exposure that things like the Mag 7, for example. How exposed are they to China? Are they to China? The answer is quite a bit. And that's the end for this report. At the end of the day, we have where they think eventually things will be. And at the end of it, they say basically stagflation, meaning stocks will go down. You have the stag and then inflation, and meaning the inflation expectations will rise, and then you have rates going higher, and it'll be a nightmare for everyone. I do believe that this is what we're seeing right now, and the kind of trade that we're seeing right now, again, potentially with the bond yields sticky at really the cycle highs, especially the long end. And stocks, yes, although rallying, you're kind of still lower for the year. I think we're about 5 or 6% lower at this point. 8%. I think that stagflation is potentially right now, but what the future holds, in my opinion, is more like this. All right, some kind of a landing. Will it be a hard landing, a soft landing? I don't know. I'm banking more on us having some kind of resolution to the economy. And again, I do believe that the summer, I think we had it actually right here. They also point to the summer of 2025 as the potential recession call. And again, not to toot my own horn here, but again, even before the tariff drama, I was looking at summer of 2025 as a potential checkpoint for the economy, just to check up, how things are going. Because again, just looking, for example, at initial jobless claims, I've poked holes in this many, many times, but just taking that face value. Last year, jobless claims bottomed at in January of 2024, and they actually peaked, and they rose as we approached the summer. And I was expecting more or less the same thing this year. Bottom in January, and a slow grind higher into the summer. Again, potentially, could we see a breakout of this range right here? We've been stuck in, about 193 till 250, 55, 57K. Could we see a breakout to maybe 300K? If we get a recession, I would think so. And at that point, that's when you would like to own something like TLT, for example. Again, that's when TLT makes its moves. TLT, I know I see a lot of people stress about TLT, and I just want to remind everyone, when TLT makes the moves that you want to see, it's when, we know for certain where we're going to go. All right? Like, look at 2008. We knew where we were going to go. Right? We had some kind of an idea in 2008. We had Bear Stearns. Bear Stearns collapse didn't help yields, all right? It drove them higher. We knew Lehman Brothers collapsing wasn't great news for the economy. It drove yields higher, all right? It wasn't until November of 2008 and really, December of 2008 that we saw TLT make the move that everyone is longing for and everybody's talking for and everybody is really waiting for TLT to make. And that was that 30% move. And again, overall for the cycle, just looking at the bottom, this was a 50% return. And again, you always have to put this in context. It wasn't just a 50% return, meaning you were making money with TLT at a time where everybody was, having their hair burned off, but having their hair on fire with the collapse in the stock market as well as gold. I'll touch quickly on gold while we're at it. I'll probably make a video about this later on. Gold was actually outperforming during the lead up till 2008. But when 2008 actually came around, then we actually started to sniff that, hey, you know what? Perhaps things aren't too hot. It actually declined about 35%. All right. Potentially we're starting to see something, maybe the beginning of that, but I'll leave that for another video. This was quite a long video if I'm not mistaken, so I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel, and I'll see you next time. Bye.